Bismillahirrahmanirrahim. In the previous class of corporate finance, we discussed about financial statement analysis. We discussed about users of financial statements, internal users and external users. Then after that, we discussed about this balance sheet. Today we are going to discuss about the income statement. You people know about the income statement. I'm just going to give you a review about this thing. This is net sales, less cost of goods sold. So we got gross profit. Then selling, general and administration expenses 402. So we will deduct it. So we will get EBIT 210. Then interest expenses 59,000. So it becomes EBT, earnings before taxes 151,000. Then income taxes of 60,000. So earning after taxes 91,000. Then we paid cash dividend of 38,000 out of 91. So we got increase in retained earnings. Means this is the retained earnings which is left and which is reinvested in the business. Now use the financial ratios. What is a financial ratio? A financial ratio is an index that relates to accounting numbers and is obtained by dividing one number by the other. Simply, it is an index. It is a standard. And this standard relates to accounting numbers, just like current ratio. You know about current ratio, which is equal to current assets divided by current liabilities. So see, we took one accounting number, we divided by another accounting number, so we will get some number. Then this number will be compared with a standard. If it is above that standard, it is good. If it is below that standard, it is not good. So what is a financial ratio? A financial ratio is an index that relates to accounting numbers and is obtained by dividing one number by the other. In ratio analysis, simply we are dividing one number by the other to get some number, and that number will be then compared with some index. Then there are two types of comparisons. One is called internal comparison and one is called external comparison. What does it mean? Internal comparison means, suppose this is 2019, this is 2018, and this is 2017. Now suppose this year our profit, it is 9%. Previous year it was suppose 13%. And the previous year suppose it was 18%. Now see, what does internal comparison mean? Comparing your present performance, 2019 performance, with your past. In 2019 it is 9%, and in 2018 it was 13, 2017 it was 18%. So it is showing that the profitability of company, it is going down, which is a weak sign. So this type of analysis, in which we are comparing our present performance with our past performance, we call it internal comparison. Then there is external comparison. External comparison means comparing your profitability with another company's ratios, or comparing your ratios with the industry averages. Industry average. Suppose this is industry average. Industry average means we took all the companies in the industry, we calculate their ratios, and then we average them. So we got some ratio. Suppose the industry average in 2019, it is 14%. Ours is 19%, and industry average is 14%. So we are below industry average. So this is called external comparison. Comparing your ratio with the whole industry average. Suppose there is another industry, market leader, company A suppose, and their ratio is how much? Suppose it is 18%. Our profitability, net profit margin, it is 9%, and the industry net profit margin, not sorry, industry no, company A, their net profit margin, it is 18%. So we are comparing our performance with some other company, or we are comparing our performance with industry average. So this type of comparison is called external comparison. So these are two types of comparisons. One is called internal comparison, comparing your performance with your past performance, your present performance with your past performance. And external comparison is comparing your performance with the industry averages or with any company in the industry. Now, this involves comparing the ratios of one firm with those of similar firms or with industry average, just like I told you about this. Similarity is important. Keep in mind one thing. Similarity is important, as one should compare apples to apples. You should compare apples with apples. Means if you are working in cement industry, so you will compare your performance with cement industry. You can't compare yourself with a hospital. So you have to compare your performance with similar companies or with the industry in which you are working. Means apples to apples, comparing the performance of your company with similar companies. Then different types of ratios. The first one is liquidity ratios. In liquidity ratios, we have two ratios. One is called current ratio. This one. Okay, I will add one thing. Sorry. First one is current ratio. What does it show? Shows a firm's ability to cover its current liabilities with its current assets. Can we pay our current liabilities with our current assets or not? This is called current ratio. This is showing your liquidity. Can you meet your short-term obligations on time or not? Can you pay your current liabilities with your current assets or not? Just like this. Current assets divided by current liability, it is equal to current ratio. Now, so it shows firm's ability to cover its current liabilities with its current assets. Now for Basket Wonders, December 31, 2003, current assets are 1,195 and current liabilities are 500. So we got 2.39. our current ratio, which is equal to current assets divided by current liabilities. So we got 2.39. Now keep in mind one thing. Standard for current ratio, keep in mind for different industries it is different. But the standard is 1.5. If it is 1.5, it is considered good. If it is below 1.5, it is not considered good. So 2.39, it is a strong ratio. What does it mean? If you have $1 current liability, you have $2.39 of current assets to repay this $1 liability. So for one payment of $1 liability, you have $2.39 of current assets to repay. You know, in current assets, which assets are coming? The most important: cash, receivables, account and note, and inventory. These are the most important ones. Then there are prepaid expenses, etc. So these are our current assets. So means if your current liability is $1, you have a lot. You have $2.39 in your current assets, means cash, receivable, inventory, and prepaid, to repay this $1 liability. Means we have 2.31 times current assets to repay $1 liability. So this means you can easily pay your current liabilities. This $1 current liability you can easily pay by this 2.39 times current assets. I told you if it is 1.5, it is good. If it is below this, it is not good. But keep in mind, if it is too much high, it is also not good. Suppose it is 4, suppose it is 5, 4 to 1, or 5 to 1, or 6 to 1. It is also not good. Why? This is showing that your management of current assets, it is not good. What does it mean? Means you have too much current assets. Either you have too much cash, either you have too much receivables, either you have too much inventory. If cash is too much in the business, it is not good because it shows you are not utilizing your cash. There is problem in the utilization of cash. If too much receivables, so it means that your credit policy is weak. If too much inventory, so this is showing that you are not selling the inventory properly. Your sales, your marketing department is not effective. So too much high cash, too much high receivable, too much high inventory, it will increase your current ratio 4 to 1, 5 to 1, 6 to 1, which is showing your weakness in either cash management, in either receivable management, or either inventory management. You people already studied these things in financial management and business finance: cash management, receivables management, and inventory management. So if it is too high, it is also showing your weakness. So this is current ratio. Now internal comparison and external comparison: 2003, 2002, 2001. Now 2.39 in 2003, 2.15 is of industry. So our ratio is strong as compared to industry. But if you will see the internal comparison, see in 2001 it was 1.91, in 2002 2.26, in 2003 2.39. So it is showing that our ratio is becoming stronger as compared to our past years. And as compared to the industry, we were below in 2001, see 1.91 and 2.01, 2002 2.26 and 2.09. Now we are above here, still we are above the industry. Ratio is stronger than the industry average. Our ratio is stronger as compared to the industry average. Then the second liquidity ratio, it is called asset test ratio or quick ratio. Why we use the word quick? Because we are using our quick current assets. Shows a firm's ability to meet current liabilities with its most liquid assets. And what are the most liquid assets? The most liquid assets are cash and receivables. Keep in mind, these are the most liquid asset. Inventory, it took time in selling. When you will sell inventory, it will take too much time. So that's why we are excluding this inventory in quick ratio. So what will be our quick ratio? What will be the formula of quick ratio? Quick ratio is equal to current assets. From all current assets, we are deducting inventory because inventory is taking too much time in selling, divided by current liabilities. See the same formula, current asset divided by current liability. Just we deduct what? The inventory, because inventory is not quick current asset. It is taking time in converting to cash. So see, for Basket Wonders, December 31, 2003, our current assets are 1195 minus our inventory is 696 divided by 500. I'm not taking these things from my own mind. These are here. These are our current assets 1195 and these are our current liabilities 500 and this is inventory. Check this. This is inventory 696. So don't think that there is a wahi on me. It is just I'm taking the values from the balance sheet. So we got 1. Our ratio is how much? It is 1. 1 is considered good. 1.00. The standard is also 1 for quick ratio. 1 divided by 1 means if you have $1 current liability, so you have $1 of quick current assets to repay this liability. 1 to 1, it is fine, it is good. Standard is also 1, but if it is below 1, it is not good. So 1 to 1, fine. Now see the internal comparison. 2001 it was 1.11, 2002 it is 1.04, it is coming down, and 2003 it is 1. So the trend is going down. The trend is going down, which is not a good sign. And see the industry 1.11, 1.25, 1.04, 1.231, and 1.25. So see the industry, their average, their uh, quick ratio, it is stable. 1.25, 1.23, 1.25, it is stable. But ours, it is going down. Ratio is weaker than the industry average. Our ratio is weaker than the industry average. But I have told you 1 to 1, it is fine. But if it is going below 1, then it is not good. So it is fine, but still as compared to industry, we are below. So our ratio is what? Our ratio is weaker. Now summary of the liquidity ratio. See our current ratio, it is about 2.39 and 2.15. But our asset test ratio, it is 1 and industry is above us. Strong current ratio and weak asset test ratio indicates a potential problem in the inventories account. Why our current ratio is high and our asset test ratio is weak? Because the problem is in the inventory. Our inventory, it is too much high. See 696, it is too much high. Because of this, our current assets are too much here. We didn't deduct the inventory from here, 1195, but here when we deduct the inventory, our quick ratio, it comes down 1195 minus 696. This inventory, it is too much high. So when inventory is too much high, our current ratio, it comes down. Sorry, our quick ratio, it comes down. So this shows that there is a problem in the inventory. Note that this industry has relatively high level of inventories. Now this is the trend analysis comparison. So see, this is the trend analysis of current ratio. Our ratio, it was weak, then it goes high. See here, this is basket wonders, this color, and this red color, this is for industry. This is industry. So we are above the industry. And see the quick ratio. So in quick ratio, industry, they are above and we are below the industry average. The current ratio for basket wonder has been rising. At the same time, the acid test ratio has been declining. So I told you that the current ratio is going up. See, from 1.9 it goes to 2.39, but quick ratio, it comes down, it is going down. See this. So here he's explaining this thing. Acid test ratio has been declining. The current ratio for the industry has been rising slowly. At the same time, the acid test ratio has been relatively stable. Our current ratio is going high and our quick ratio, it is going down. Industry, their current ratio of the industry has been rising slowly. Their current ratio is rising slowly. At the same time, the acid test ratio has been relatively stable, but their quick ratio, it is stable. This indicates that inventories are significant problem for basket wonders. This is showing that there is problem in the inventory account. Means our company is not focusing on the sale. Means that their marketing department, their sales department is not that much effective. Now the next ratios are leverage ratios. The first one was liquidity ratio. Now we are going to discuss leverage ratio. This is balance sheet ratios. See, the previous one, it was also balance sheet ratios. because both the items are from the balance sheet. Same is the case here. Current assets, current liabilities, so both are balance sheet items. Same is the case here. These are also balance sheet ratios, financial leverage ratios. Shows the extent to which the firm is financed by debt. Leverage, the use of debt financing in the business. Leverage is the use of debt. So here we will talk about the debt ratios. So the first one is debt to equity. This is showing the extent to which the firm is financed by debt. What is the formula? Debt to equity is equal to total debt divided by shareholders' equity. For Basket Wonders, December 31, 2003, total debt is equal to 1030 and shareholders' equity it is equal to 1139. So we are getting 0.90. It means total debt divided by total equity. Our ratio comes 0.90, 0.90 divided by 1. So it means if total equity is $1, total debt is $0.90. Comparison. If your total assets are 1.90, asset is equal to liability plus owner's equity or capital. So now, if total assets are 1.90, out of this 1.90, 0.90, it is debt and plus 1 given at 0.90 plus 1 and 1 is the owner's equity. Now compare it. 2001 0.81, 0.89. The industry debt ratio it was high, 0.88 and 0.90. Still the industry is high. Now V equals the industry average. Has average debt utilization relative to the industry average. It is showing that our debt utilization and industry debt utilization it is same. What does it mean? This is showing that the amount of debt financing, the amount of leverage that we are using, industry is using the same level of leverage. So debt financing is good or debt financing is bad? Debt financing is good, but the main thing is the utilization of debt. We took 0.90 debt out of our total financing. So now how much profit we are generating and how much profit the industry is generating. The problem is here. Our utilization and industry utilization, it is same. But the problem is what will be our profit and what is the profit of the industry. At the end, when the profitability ratios comes, then we will discuss about this. So then at the end, we will check that what is our profitability. We took 0.90 debt. The industry also took 0.90 debt. What is our profit and what is the industry profit? Then we will compare the utilization. The main thing is the utilization of debt, whether we are utilizing it properly or not. Then in financial leverage ratios, there is another one, that is debt to total assets. Shows the percentage of the firm's assets that are supported by debt financing. Percentage of firm's assets that are supported by debt financing. Means suppose if your total assets, these are 100%. So out of this 100%, what is the percentage of debt and what is the percentage of equity? Now check here. Shows the percentage of the firm's assets that are supported by debt financing, which is equal to total debt divided by total assets. Our total debts are 1030, it is in thousand, and our total assets are 2169. So we got 0.47, which means out of 100%, 47% it is debt and the remaining 53% it is equity. So this shows our capital structure. This is giving us information about our capital structure. So 47% is our debt and 53% is our equity. So debt to total asset, it shows the percentage of debt in your total assets. So percentage of debt, it is 47%. 47, 47, 45. So internal analysis, it was 45%, then it goes to 47, then it goes to 47, and industry, it is on the same level. So but Basket Wonder has average debt utilization relative to industry level. But I told you, the main problem is, the main thing is our debt utilization. Okay, it is equal to industry, but how much profit you're generating on this debt. So the main thing is the generation of profit, that how much profit generating, how much profit you're generating on your debt. So this will come and we will go to the next ratio. I think for today, I think it is enough, 33 minutes video. So then it will be problem for you. So in the next class we will discuss another financial leverage ratio. So okay, have a good time.